3 steps to read stocks like a pro. Invest with logic, not emotion. Introduction. Have you ever heard someone say, if you want to invest in stocks, you have to be smart, study for years, understand all kinds of complicated indicators, technical models, charts, FAQ, and everything under the sun? And then you nod and back off, telling yourself, maybe investing isn't for me. Hold on. The truth is, you don't need to be an expert to pick good stocks. You just need to learn how to see things the right way, and today I'll show you how. No dry theory. No academic jargon. Just 3 incredibly simple steps. But if you apply them correctly, you'll instantly see stocks through the eyes of a professional investor. You'll learn to tell the difference between stocks with real value and stocks that are just inflated by hype and rumors. Companies with solid financial foundations and those that only look good on paper. When to buy and when to stand on the sidelines. I've been in your shoes. I got swept up in bull runs, FOMO, insider news, VIP chat rooms. I followed the crowd, only to panic when the market crashed. But these 3 simple steps changed the way I invest forever. I no longer stress every time the market shakes. I don't need to stare at stock screens all day. I invest less, but my results are better. And the best part? You can start today, even if you're 100% new. No fancy software. No deep financial analysis required. Just a piece of paper, a bit of logical thinking, and 15 minutes of analysis each week. With just 3 steps, you will avoid the common traps that 90% of new investors fall into. Confidently choose stocks that match your strategy. And build a portfolio with real foundation and strength. You might be thinking, is it really that simple? The answer is yes, if you're ready to think like an investor, not a gambler. And here's my promise to you. At the end of this video, I'll give you a 1-page stock evaluation formula, enough for you to analyze any stock you're interested in. Free. No app download. No sign-up needed. But only if you stay until the end. Because if you can't stay focused for 10 minutes to learn 3 simple steps, you won't have the patience to hold on to good stocks for 3 years. And that's exactly why most investors lose money. So, if you're truly serious about your money, keep watching. Let's dive into the 3 simple steps to evaluate a stock and change the way you invest forever. Part 1. Look at revenue and profit. Don't pick stocks like lottery tickets. Have you ever heard someone say, this stock is about to boom. Jump in now and make 30% profit instantly. My friend just bought this stock. It's hit the ceiling 5 days in a row. Sounds exciting, doesn't it? But do you know what lies beneath those whispers? It's ignorance. Blind investing. The fastest way to fall into a trap. If you want to be an investor, you can't pick stocks like buying lottery tickets. You need to look at what most people ignore. Revenue and profit. 1.1. Revenue and profit. The health meter of a business. Imagine a business as a living body. Revenue is the breath. Without it, the business suffocates. Profit is the heartbeat. Without it, the business slowly withers. If you choose a stock without knowing whether the company is breathing steadily and its heart is still beating, You're betting your money on a sick patient you've never examined. 1.2. Look at the past 3 years' revenue. Is there real growth? The first question to ask: has the company's revenue been steadily increasing over the past 3 years? Steady growth doesn't mean skyrocketing like a rocket. It means sustainable and stable growth. Look at the revenue chart. If you see a smooth upward curve, not erratic or falling, that's a good sign. For example, Company A has the following revenue. 2021, V&D 4,200 billion. 2022, V&D 4,900 billion. 2023, V&D 5,300 billion. Not explosive, but stable. And what does this tell us? The business can retain customers, expand markets, and grow organically, not just riding a temporary trend. 1.3. Is profit following revenue? Revenue growth alone is not enough. You need to check, is profit increasing too? Because many companies inflate revenue by slashing prices, spending heavily on marketing, but actually selling at a loss just to gain market share. Looks good at first, but long-term, it bleeds them dry. Let's look at Company A again. 2021, net profit, V&D 280 billion. 2022, V&D 320 billion. 2023, V&D 390 billion. Perfect. Profit is rising with revenue. This shows the company is operating efficiently, controlling costs, and maintaining a healthy profit margin. 1.4. Don't be fooled by fake profits. One of the biggest traps is sudden profit spikes. You look at the report and say, wow, the company made 3x more profit than last year. Be careful. Ask immediately, why did it increase so dramatically? It might be from selling assets, land transfers, or liquidation of investments. These gains are non-recurring. They don't reflect real business performance. Example, a real estate company posts a profit spike from selling a plot of land in Thursday Tame. Next year, nothing left to sell, profits drop sharply. You jumped in, seduced by beautiful numbers, and ended up with expectation poisoning. 1.5. Ask yourself, is this business growing or just acting? Ask these 3 simple questions when looking at financial reports. Has revenue increased steadily over the last 3 years? Does profit rise in line with revenue? Are there any unusual spikes in the numbers? If the answer to all 3 is yes, you may have found a promising stock. If even one answer is no, be careful. Don't let emotion beat logic. 1.6. Don't be swayed by rumors, let the numbers speak. A friend once told me, I bought this stock because the company's CEO seems so sincere in live streams. Sounds touching, but emotions don't earn sustainable returns. Let the financial reports speak. Let the numbers lead the way. If revenue and profit aren't speaking the same language, don't invest. 1.7. Step 1 Summary. Learn to see like a fund manager. Did you know? Major investment funds always begin with analyzing revenue and profit. Not because they lack time, but because they know. If the basics aren't strong, nothing else matters. You can do the same. Fifth, download the last 3 years' financial reports. Record the revenue and profit. Compare growth trends. Highlight any unusual fluctuations. Simple, effective, and you'll immediately start seeing stocks with a different mindset. Are you ready? In part 2, we'll explore the next vital indicator, one that, if ignored, might lead you to buy a stock that looks shiny on the outside but is hollow within. Let's continue and build your investor mindset like a pro. Part 2, Profit Margin and Debt, Decoding a Company's Hidden Strength. Have you ever seen a company with trillions in revenue and hundreds of billions in profit, but just one small market fluctuation sends it crashing? Because on the inside, it's weaker than you think. Like a muscular person whose organs are decaying, even a mild flu can take them down. So how can you spot that? Today, we'll dissect 2 indicators of a company's internal health. Gross profit margin. Debt ratio. 2.1. Gross profit margin. The shield that protects in stormy markets. Have you ever run a business? If you buy a product for $1 million and sell it for $1.2 million, you earn $200,000, a gross margin of 16.7%. If the next day, the cost rises to $1.1 million but you still sell at $1.2 million, your profit drops to $100,000, margin falls to 8.3%. This happens inside businesses every day. Why is gross margin important? High margins equals the company has pricing power. Low margins equals the company is vulnerable to cost increases or sales decline. A manufacturing company with a gross margin over 25% is worth noticing. A retail company maintaining over 10% is also a good sign. 2.2. Reading the margin chart. Muscle or just hot air? Take this example. Company B has rising revenue and profit for the past 3 years. Sounds good, right? But look at the gross margin. 2021, 25%. 2022, 22%. 2023, 17%. The numbers are steadily declining. But maybe the company is cutting prices to retain customers, or raw material costs are rising too fast to control. Even if revenue and profit are growing, a falling margin signals real pressure ahead. You should be cautious. 2.3. Stable margins, a sign of good control. On the other hand, if a company's gross margin isn't super high, but stays stable over the years, outperforms its industry peers, shows gradual improvement, that's a sign the company controls its costs, manages its production processes, has strong bargaining power with customers. That's true inner strength without needing flashy ads. 2.4. Debt ratio, the hidden curse in financial statements. Next question you should ask: is this company living on borrowed money? The debt ratio is often ignored by beginner investors, but for big funds, it's the first thing they check. Look at the debt-to-equity ratio. Below 0.5, the company is operating quite healthily. 0.5 to 1.0, you need to analyze cash flow. Over 1.0, warning. The company is growing on a borrowed foundation. 2.5, don't let profits fool you. IT takes cash to pay interest. A company may borrow heavily and still show strong profits, but if interest rates go up, banks tighten credit, cash flow doesn't come in on time, they'll choke on their debt, forced to sell assets, issue new shares, diluting ownership, or go bankrupt. Example: in 2022, when interest rates spiked, many real estate firms with debt to equity over 2.0 crashed, even though they had reported trillions in profits before. 2.6. Combining both indicators. Finding steal companies in chaos. An ideal company would have gross profit margins from 20 to 40%, depending on industry. Debt ratios under 0.5, or well managed through operating cash flow. This is a sustainable financial model, less affected by interest rates, raw material costs, or crises. When the market crashes, these companies stay strong and even buy out weaker rivals. That's when their stock price surges once money flows back in. 2.7. Ask yourself these questions before buying a stock. Before making a decision, sit down and ask, is this company's gross margin stable or being eroded? Is the current debt level safe if the market turns worse? Is the business thriving on real performance or borrowing to look good? If you can answer these three, you're no longer a trend-chasing investor. You're thinking like a professional. In Part 3, we'll move to the final step, reading cash flow and evaluating valuation. A step that answers, is this stock cheap, fairly priced, or overhyped? And most importantly, should I buy it now or wait for the right moment? Part 3. Cash flow and valuation, unlocking the true value of a stock. Have you ever heard this saying? Profit is an illusion, cash flow is reality? On financial statements, there are hundreds of ways to beautify profits. But cash flow, the actual money flowing into the business, doesn't lie. Imagine a company like a pho noodle shop. It sells 100 bowls a day, earning 10,000 VND per bowl. But customers keep delaying payment. The money never comes in. On paper, there's profit. But in the cash register? Nothing. Such a business will soon die of thirst in a desert of paper profits. 3.1. Cash flow from operating activities, the lifeblood of a business. Step 1. Open the financial report and look for the line. Net cash flow from operating activities. If this number is positive and consistent year after year, congratulations. The company is generating real cash from its core business. If it's negative over time, even when reporting profits, be cautious. Real-life example. Many real estate firms reported hundreds of billions in profit, but had negative operating cash flows of trillions because selling projects but customers haven't paid, borrowing more to cover expenses, profits on paper, but no actual cash received. The result? When banks tightened credit, these companies ran out of cash and collapsed. 3.2. Investing and financing cash flows. Expansion or struggle. Besides operating cash flow, you have two more groups. Investing cash flow. Is the company buying assets, factories, equipment? If reasonably negative, a sign of growth and expansion. Financing cash flow. Are they borrowing or repaying debt? Raising or reducing capital? An ideal company will generate positive cash from operations, reinvest in profitable activities, reduce debt and pay fair dividends. On the flip side, if operating cash flow is negative, forced to borrow, paying dividends with debt, that's a risky spiral. 3.3 Stock valuation. Don't overpay for a dream. Let's say you found a solid business, stable profit margins, low debt, strong cash flow. The next question is the stock cheap? This is where valuation comes in. 3.4 P ratio. As simple as buying a phone. PE stands for price/earnings, stock price divided by earnings per share. P equals 10 means you're paying 10 units of price for 1 unit of profit. Lower P, the stock is cheaper. But a low PE might mean trouble. The company could be declining. Example: stock A has P equals 8. Stock B has P equals 20. If B is a fast-growing tech company and A is in decline, then low P isn't necessarily better. So compare PE with industry average, the company's historical PE, future prospects. 3.5 B ratio. Buying a bargain or paying for quality. P B equals price/book value, market price divided by book value per share. P B equals 1 means you're buying the company at the value of its assets. P B less than 1 could be a bargain or a red flag. P B greater than 1 suggests investors expect future profits above asset value. Quick tip. In industries like finance, banking, and insurance, P B often gives better insight than PE. 3.6 PEG ratio. Looking to the future, not just the past. A more advanced tool is PEG equals PE divided by profit growth rate. If PEG 1, the stock might be undervalued. If PEG greater than 1.5, it could be overpriced relative to growth. Example: stock has P equals 15. Profit growth rate equals 20%. PEG equals 15/20 is equal to 0.75, attractive valuation. 3.7 The golden question. How much are you paying for 1 unit of profit? Before hitting buy on any stock, ask yourself, how much am I paying for each unit of profit or real value? And more importantly, am I buying because it's cheap or because I see real growth potential? If you can answer that honestly, you're not just buying a stock. You're buying a well-thought-out investment story. Summary: 3 steps to evaluate a stock. Profit and growth. Is the business genuinely profitable and sustainable? Margins and debt. Is it financially strong enough to survive a crisis? Cash flow and valuation. Does it generate real money? Is the stock price reasonable? Just 3 steps. But if you do them right, you'll filter out 90% of stocks not worth buying and focus only on the few truly deserving ones. If this video helped you gain a deeper understanding of investing, don't forget, like and share to help others avoid investment traps. Subscribe to the channel so you won't miss more in-depth value analysis videos. And comment below, which of the 3 stock evaluation steps are you applying right now? Summary. Dear friend, We've just walked through a journey of only 3 steps. But if you truly absorb and apply them, you'll find yourself standing apart from 90% of investors out there. They buy on rumors. They sell out of fear. They chase waves without knowing what they're doing. But not you. Because from today, you've learned how to analyze stocks with intelligence, not emotion. You now know how to evaluate whether profits are real or just numbers on paper. Understand the true strength of a business. Follow the cash flow and judge whether you're buying cheap or overpaying. And most importantly, you're investing like someone who understands the game, not a pawn in someone else's play. If this video has helped you, don't keep it to yourself. Share it with your friends, coworkers, and anyone you want to grow with on the financial journey. And if you want to go deeper, to learn more, to practice step by step, and upgrade your investing mindset, subscribe to the Bold Steps Forward channel today. Because this is only the beginning of a much greater journey. We'll be back with videos on real-world case studies, deep dives into trending stocks, step-by-step guides on valuation, risk management, and building a winning portfolio. Leave a comment below. I'm ready to invest with the right mindset. I read and respond to each one personally. Thank you for watching until the end. See you in the next video, where we'll take bolder steps together towards smart investing. Bold steps forward. Let's move ahead together.